I find this quotation from Winston Churchill very relevant to the situation we're in today. These are some of the primary institutions that we have shaped over the past couple of centuries. None of them are really applicable in a world with non-ergodic capital dynamics. These are leading to a world suffering from the consequences of significant negative externalities: climate change, resource degradation, numerous other aspects of our polycrisis. Many, if not all of these, are consequences of, at least in part, neoclassical economics blithely sweeping under the carpet the non-ergodic dynamics of capital. You see here the coin toss experiment that quite likely all of you, or at least most of you, are familiar with. In this case, regard this as companies where the probability of growth or loss in a given week is 50-50, either growing 32.68%, losing 30%, which is designed to represent a typical target in the startup world of a company doubling in size each year. And as you may well know, you see the difference between a portfolio of identical companies with no cooperation between them and exactly the same companies on exactly the same paths, but where there is a profit pooling mechanism between them. 2% of the profit is pooled each week. This is at the heart of what we're building in Evolute 6, a profit pooling mechanism between companies in such an ergodic ecosystem, and where the focus is on companies that have a regenerative contribution. We need to get everything that is being invested according to the insights of the non-ergodic dynamics of capital. If we carry on investing and building businesses assuming incorrectly that the world is ergodic, we're not going to address the complex challenges we're facing. To do this, we need to build ecosystems of companies that have fractional profit pooling between the companies in the ecosystems. Make sure that the range of companies in the ecosystem is sufficiently diverse that you have a wide enough spectrum of counter-cyclic responses to the various things that are happening in the economy around each business. The single most critical driver of success for such a profit pooling ecosystem is a very high degree of systemic trust between all of the different players in the game across space as well as across time. We need high levels of trust between the different types of stakeholders in a company, the investors of financial capital, natural capital, time capital, intellectual capital, the relationship and social capital of the cities. We need very high levels of trust between all of those, and that trust needs to be stable across long periods of time. If we want to build a circular economy within such a regenerative ergodic ecosystem, we need to have trust that spans at least 5 cycles of a circular economy. That means trust over 50 to 100 years. This requires absolutely systemic trust, and that's what companies are designed for. The original creation of the incorporated entity was a way of creating systemic trust between the investors of financial capital who were now no longer part of the same family. Companies had grown sufficiently big that they needed more money than any single wealthy family could provide. So we know how to create systemic trust between stakeholders that do not necessarily know each other, like each other, or even agree with each other. It's called the company. We just need to replicate that now across all stakeholders and all capitals, not just financial capital. Creating that trust is at the heart of everything we're doing in Evolute 6 in our venture builder. And we've been developing this way of incorporating companies, the Fair Shares Commons that you see in the top left of this diagram, for over 15 years now, by extending on things like multi-stakeholder cooperatives, the work of Mondragon, and various other endeavors. And that's integrated with ways of running the organization, such as sociocracy, and ways of interacting as human beings, such as our adaptive way, all of which are designed to harness the tension between different stakeholders as a source of structural integrity. In other words, as ways of enabling cooperation despite the different people cooperating or different companies cooperating, perhaps not necessarily liking each other and being in some sense also in competition with each other. This enables us to regard cooperation and competition as two independent axes rather than a forced compromise line. These are some of the key characteristics of a fair shares commons. First of all, note that it can be built today and is being built today with existing legislation. The first incorporation in the US was in Delaware in 2016. We have a number of companies in England and Wales, in Scotland and in Ireland. And we've had a framework program across the European Union confirming that it can be built within the EU. And we have a project underway in Nigeria. Some of the other key characteristics of such a fair shares commons: all of the capitals, all of the stakeholders have governance rights and have a share of the dividends and capital gain generated. For stakeholders that do not have the capacity for direct voting, such as future generations or the biosphere of the planet or the integrity of the company, perhaps the city that a company is operating in, those are represented by stewards. The stewards are mandated to vote according to the principles of stewardship, very much as in a foundation or a trust, and they are required to vote in the interest of the long-term future of the company. One other aspect of the stewards is the stewards have a veto to prevent things happening to the company that are contrary to the bigger picture, the long-term interests. In particular, they have a veto for anything that might lead the company to being sold. This is also central to how the fair shares commons is built. It recognizes that in law, a company is a legal person party to a contract with the investors. It is not actually in company law the property of the investors. That myth is an artifact, a consequence of the way that the governance rights are typically structured, where the investors have all of the voting power. Also, the fair shares commons enables the investor shares to be freely traded, as in a standard limited company. What this means is the fair shares commons really integrates all of the desirable features of all of the different forms of incorporation out there in such a way that we can really build companies with the best of everything. And most importantly, the fair shares commons is designed to enable cooperation at an ecosystem level between companies that compete at a direct level. It enables ecosystemic trust. All the companies in the ecosystem govern the profit pool. The profit pool has voting rights, governance power in each of the companies in the ecosystem. Companies within the ecosystem also have interlocking governance rights in each other. This enables the ecosystem as a whole to ensure that none of the companies are acting as a free rider. None of the companies are excessively parasitic, excessively exploitative, that any company that is at the end of its lifetime can be shut down in a clean and healthy way for the benefit of the entire ecosystem. All of these and many more characteristics are essential to run a fractional profit pooling mechanism in the real world with real human beings, with the power dynamics, the reasons for mistrust, all of the other things that give the corporate world so many of the dynamics that are part and parcel of human society. You see here some of the companies that we've already built. In total, we've worked with over 42 companies. One of the companies is already listed on the Viennese Stock Exchange. We have other companies like, for example, Co-op Exchange, that is being built as a stock exchange, as a secondary market for the investor shares of Fair Shares Commons, Fair Shares and cooperative companies. We have also a number of companies that are in the process of being built in Latin America, the North Americas, and in Europe. So part of the key message of this is this has been underway now for 15 plus years. We have already built a number of companies. We have good experience of how to build companies for cooperation, for collaboration. There's only one missing ingredient,